Hi, I'm Joe Masick, Portfolio Manager with IA Private Wealth, and this is my commentary for the first half of 2021, so let's jump in. Thank you for tuning in to my market commentary for the first half of 2021. We have a lot to cover from the last time I posted, and I'm so looking forward to reviewing what I thought about the markets then and how things are working out today. But before we get into the video, I'd like to go through my usual disclaimer, which I've put in written form here to save time. But the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. The other thing you need to do is smash that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and you want to be kept in the loop with all of my newest videos, I would be thrilled if you would just hit that subscribe button and darken the notification bell. Making suggestions for future video topics and leaving supportive views as to how you enjoyed the content would be very much appreciated in the comments section of my video below. It helps the YouTube algorithm push my content towards new viewers, so please feel free to write something down below and help grow my channel. With that said, any questions requiring advice should be sent to me directly through email, as I won't be able to reply back to these through my comments section, but I would be happy to try to help you out on a one-on-one basis. So as of this writing, we have pretty much just gotten through the first half of 2021, and I want to go through some of the thoughts I had in the previous market commentary and address which thoughts were correct, which ones have yet to unfold, and ones that surprised me. With that said, I know it's been a little while since I posted a commentary, but as the year progressed, I genuinely felt the first and second quarters were very similar in nature, and I really didn't want to create the same video all over again. So I opted to join both commentaries together and make a first half commentary. I also had some other videos I wanted to get out, and as you may or may not know, I do fully write, edit, and produce my videos with my assistant Tadiso, so these can take a little bit of time to get out. Moving right along to this commentary, I also wanted to share some new ideas as to how the last half of 2021 might play out, and if my thoughts had changed since I did my last video. So for a quick review, we had a freshly minted president in Joe Biden, and I thought the markets would likely continue to rise, but be choppy given the fact that the balance sheet was still being expanded, and there were a few questions surrounding vaccination rates and whether or not there could be another taper tantrum. And the overall theme was that we were moving from a market with a lot of uncertainty into a market that had a lot more certainty built into it. And today it seems that we have settled into a market that has become more accustomed to the new normal. In the first 100 days of Joe Biden's administration, he made it clear he was going to focus on supporting a recovery through fiscal stimulus and a strong vaccination campaign against the illness. I would suggest that this was a success, as a new stimulus package was eventually passed, and anyone who wanted the vaccine down south was able to get one by the second quarter. As a result, we started to see sports events being fully attended in the second quarter, and the US seems to be well underway in fully reopening. I will admit I was somewhat stunned at how quickly vaccinations happened in the US and globally, as we have over 5 billion people with their first dose and over 2 billion people fully vaccinated at the time of this writing. What is also interesting to note is how slow Canada was to initially receive doses of the vaccine, but is now a world leader in vaccination rates and quickly approaching 80% of the population fully vaccinated over 12 years old. This is an important statistic, as reopening plans for countries depend on high vaccination rates to achieve herd immunity, and it is widely viewed by governments as important for a sustained recovery. Israel was one of the first and fastest countries to administer their vaccines, and early on, new transmission of cases plummeted to almost non-existent numbers, allowing for the country to open up and to prosper. But later on in the year, we are now seeing that Israel's cases are on the rise again, thanks to the new Delta variant. However, hospitalization rates still remain muted, supporting the case for vaccines to be effective. This was a question I had from my last commentary that has somewhat been answered. However, more questions remain surrounding the unvaccinated population population, as cases seem to be on the rise in those areas with weak vaccination rates. These waves coming from new variants will likely add to the choppiness of the markets, as we don't really know whether or not booster shots will be fully implemented on a global scale or not. The first half of the year did see a very nice appreciation, but again, it wasn't without its volatility, and I expect this to continue for as long as the Federal Reserve continues its bond purchasing program, which as of this writing is over $8 trillion. For those of you that don't know what this looks like, this is a Federal Reserve total assets chart. And as you can see here, the Federal Reserve has been increasing the size of these asset purchases since the global financial crisis in 2008. As the assets grow on this balance sheet, some would say this has had the effect of cutting interest rates. And it is speculated that during the global financial crisis, this expansion from just under $1 trillion to over $4 trillion had the equivalent effect of cutting interest rates by an additional 3%. You see, once you cut rates to zero, unless you go negative interest rates, you can't cut any further to provide more liquidity to the markets. So the Federal Reserve expanded the balance sheet to compensate for the inability or unwillingness to cut rates below zero. Fast forward to this part of the chart, and you can see here that the Fed was starting to taper or roll off the balance sheet, which had the effect of hiking rates and reducing liquidity. One of the main arguments that I had against the Federal Reserve actions that they took 2 years ago is that never in the history of the Federal Reserve have they ever expanded the balance sheet to this level. So it would stand to reason that as they rolled the purchases off, they would not have any idea how it would affect the liquidity of the markets. Janet Yellen equated the rolling off of the balance sheet to, and I quote, watching paint dry. And many in the Federal Reserve believe that they could reduce the balance sheet while at the same time hiking interest rates. I believe these actions were the key factors responsible for a massive reduction in liquidity, and chiefly responsible for the inversion of the yield curve, which historically has been an extraordinarily reliable predictor of recession and market collapse. Janet Yellen, of course, disagreed with this and said the most dangerous words in the English language when it comes to the markets. This time it's different.
Investors often look at the behavior of interest rates to figure out what signal they're sending about where the economy is going. We have something now called an inverted yield curve, where long-term interest rates are lower than short-term interest rates. Can you explain to us what signal that's sending and what it means for the broader economy?
So historically, it's been a pretty good signal of recession, and I think that's why markets pay attention to it. But I would really urge that on this occasion, it may be a less good signal. This time is different, although clearly markets are worried.
This time is different.
You use those words that economists often regret. This time is different.
Yes, I guess I did.
Well, of course, now we all know that she was not correct, and this time it wasn't different, and the market was unable to withstand the next black swan event, which happened to be a global pandemic. As the market collapsed in March of 2020 by upwards of 40%, the Federal Reserve quickly reversed their tightening, immediately cut rates to zero, and subsequently increased the balance sheet to now over $8 trillion and counting. To truly understand the effects of the balance sheet expansion, one must look at the correlation between the S&P 500 and the Federal Asset Purchase Plan, which is clearly shown in this chart. The correlation between asset prices, in this case the S&P 500, going up and the expansion of the balance sheet is extremely strong, which brings me to my next thesis for the latter half of 2021 and into 2022. The stock market has risen substantially in the past 12 to 18 months, and the markets will likely continue to rise as long as the Federal Reserve is accommodative. Further evidence is shown in the shape of the current yield curve, as it is normal and fairly steep, which is signaling decent growth ahead for the markets, as overvalued as they may seem. Oil prices remain reasonable and Libor rates are low, along with low TED spread rates. All of these indicators point to growth ahead, and while the overvaluation of the market was and still is a concern, as the economy recovers, I said in the previous market commentary, rich valuations will likely persist as more fiscal stimulus and continued asset balance sheet expansion takes place. Again, this suggests the current liquidity added to the market would be more than sufficient to be able to withstand potential black swan events as they may arise. This is certainly not to suggest that we could not see a meaningful decline and corrections of anywhere between 10 and 15% in the future. But with added stimulus, it's very hard to make a case for an outright collapse. And we continue to have this thesis as our base case for continued growth in the markets. One question I had on my mind in the last commentary was, what happens when the stimulus stops and the Federal Reserve and the government attempt to have the market and the economy survive without it? Well, we got a bit of an answer to that a little while ago, as the markets did sharply sell off when Jerome Powell just hinted at rising rates, and the mere mentioning of tapering seemed to rattle markets for about a couple of weeks. We could very well have a repeat of the taper tantrum in 2013. So it seems likely that the Fed will stand pat on rates and tapering for the foreseeable future, setting us up for higher markets going forward until it is very sure the market can handle quantitative tightening again. In our portfolios, we have consistently reduced our cash positions and added to our sizable equity positions over the first half on days the markets have sold off. And as we've mentioned in our last commentary, we would do this as we felt more comfortable with the direction and the stability of the markets. We have also reduced our market neutral positions in favor of other longer-term higher growth alternatives to take advantage of the next expansion, focusing particularly in real estate, as we believe hard assets will continue to appreciate. We also still anticipate the markets being relatively good, but volatile over the shorter term prior to another longer expansion. In future videos, I will be going through the indicators we look to help forecast our models, but in short, the main indicators we use, like the shape of the current yield curve, oil prices, Libor rates, and TED spreads, are all favorable at this time. We also factor in a number of other indicators, but those are the main ones, and I am looking forward to dedicating entire videos to each one, as they really need their own videos to explain fully why I feel they're so important. So with all that said, I want to at this time thank you for tuning in to Investing Made Simple, and please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you love my content and want to be kept in the loop with all of my newest videos, I'd be very happy if you just hit that subscribe button and darken that notification bell. Until next time, this is Joe Masick, Portfolio Manager with IA Private Wealth. We'll see you soon.